afternoon and welcome. Perhaps welcome back if you tuned into the first 15 episodes of Chicago Future of Finance. I'm Oliver Renick. The lower third I just put up proves it. This is Cboe. There's no other place like it in the world. That's what makes this show special. And we're also changing things up a little bit from the first round. This is a bit of a different beast, this version. I'm going to be producing the show with the backup of my great Cboe squad. Big shout out to Jack and Matt for continuing to build the infrastructure for this. A special shout out to the crew at Benzinga as well, Brad Olson, Aaron Thomas, who helped get this together so we could stream it to the Benzinga audience, which is obviously a very engaged investor audience, and that's what the show really is about. Chicago Future of Finance is essentially what you see behind me as my other co-anchor, which is the intersection of finance and all the major themes that have been behind capital markets and the boom in trading. Right now, markets are coming off a little bit, and what makes this so special back here is that it really is the infrastructure, the pipes that have allowed the massive growth of the post-COVID trading era, one that's been robust and that has had retail one step ahead all the way. The market makers, the execution, the brokerages that built this post-COVID capital markets, it's all happening behind me. A lot of that stems from options as well, of course. This really is the home of options, and the trader too. A lot of the machines that are whizzing on the New York Stock Exchange and those algos that were programmed in New York over the last decades, those orders find their way here. Part of what you see behind me are people monitoring those machines, making sure the slots are still running. But there's also folks here who are finding edge and carving out new strategies. That's where the derivatives market plays such a key role. The coverage here and what you can expect from this show is largely option-centric. That's because it's where really the edge is. And a lot of it makes sense. This is a healthy market for the most part. Pretty much entirely, because a lot of people are sitting on big gains in stocks and they use options in the most kind of basic format of options trading to buy insurance and protection. There's people here selling and collecting income on that, and that's kind of the primary function. But there is a lot of complications and really unique strategies that people are employing. We'll get into that. I also want to remind you that the future of finance and why it's in Chicago is because of the advisor market. The first 15 episodes, we spent a lot of time in the Wealth Channel talking about how advisors based here in Chicago have become this giant money center as the advisor world has private equity money behind it and is effectively competing for the 40 part of the 60-40 portfolio with options also in competition as a solution for income. Those are the two major themes, but over the next couple months here, from now until the end of the year, this is a show that's going to be centered more on trading than it was the Wealth Channel. That's because I've got a great lineup of some legendary guests who are going to be the contributors on the show here going forward. Now, the other thing, too, is that the market's getting pretty interesting right now. We've had a little bit of a pullback. Things have slowed down a tiny bit. Crypto's under some pressure. So I think this is a really good time to go through the market and really pay a very close attention to some of the major changes that are happening. Let's talk about also Cboe, too, for a moment as we continue to paint the picture. This is going to be a conversation not just about options, but the way options are moving into the ETF world, and that's really where the advisor market connects with options. Cboe's opened its doors to us in its sprawl of ETF listings. We'll be profiling over the next 6 weeks or so some of the most interesting listed funds here at Cboe. I'm also going to be with the Benzinga crew in New York, and by the way, as I mentioned, the interesting thing about this show too, that I have been working with, that I've handpicked for a long time. People that are at the top of their game, people like Scott Bauer of Prosper Trading Academy. I've learned a ton from him over the years. The guy was one of the first options traders here, the first market maker in Amazon. Brent Kochuba to his right of Spot Gamma, of Wolverine background, Wex, a major player here on the Cboe exchange. Brent Kochuba is going to be here as basically the Sherlock Holmes of options flows. Spot Gamma has some of the best visualization tools in the game. So we'll be in that platform tracking the options flows. Noel Smith from Convex is cut from that same cloth of Chicago-based background, an early investor in some of the big trading shops in Chicago. And of course, the bros. Pete and John, the Nigerians, legends not just of finance and trading, but media too. And we've got the perfect spot for them, which is the gamble. That's a little tease. We'll come back to it. We're going to talk event contracts because John and Pete are not just finance minds, they're sports minds. They're That's what's really important about that, is that when the future of finance includes event contracts, our scope of what we're talking about is going to be broad here. So I'm glad you're joining. Bear with the new format a bit, because if I'm on my computer, if you see me typing, it's not because I'm distracted. It's not because I'm playing poker or something. It's because I'm clicking the buttons and running the show. All right, Brent Kochuba is with me, and that's where I think we start the conversation, because the market has come off a little bit. Brent, the founder of Spot Gamma. You hear me, Brent?
Yeah, loud and clear. What's up, Oliver? How are you doing?
All right, beautiful, man. Great to have you back. A fixture in the first 15 episodes of this run on this show. Let's talk about the market, Brent, when you've got this volatility. And look, I'm at VIX 20.5 right now. That's obviously a little bit of a shift from the 17 of the last couple of days and generally the steady grind of stocks. What stands out to you?
We went from a very overbought position last week, so that's the first thing. If you look at call skews across Mag 7s, S&P, Qs, NASDAQ, everything, we were 95th percentile on call skews last week into the Fed, into some of the Mag 7 earnings, into the U.S.-China Trump Z meeting. So we were very, very overbought last week. I think some of that is getting burned off here. S&P is down 1%. We're seeing some pretty heavy call selling on the single stock side. But there's not this massive bid for puts in the S&P. We did see VVIX lift a little bit, which suggests that there was some VIX call buying out there into this trade itself. So, right now it's sort of a stirred, not shaken market. And I think that you can paraphrase this mainly as some reversion to the mean after getting a little too extended. The big thing is we have AMD earnings tonight. That's a big one. You still got the government shutdown. You have the elections tonight, which may or may not be a huge deal. Rates made pretty big moves after the FOMC. I think everyone was pretty bulled up on the bond market. We saw call skews, for example, and stuff like TLT, KRE, XLF. Those all burned off as rates moved after the FOMC moved higher. So, I think there was just a little bit of a reset, a little bit of an adjustment. And as far as I am concerned, this thing is not dead until NVIDIA kind of says it's over, right? So, and those earnings are coming up here in about 2 weeks. So,
Okay.
I think as long as you have that AI narrative, yes, things are a little choppy right now, but, if you've doubted this market at any point this year, you've been proven wrong. And I think that we still have to sort of lean on that. People are likely to buy the dip. On that point as well, vol is such an asset class now that every time vol seems to spike a little bit, we see a lot of people come out and try to monetize that. It's also such a source of alpha in this market, in this current environment we're in. You alluded to the post-COVID environment. Put selling, vol selling, such a big source of alpha. And so I think a lot of people like to try to take their shots. On that point, yes, the VIX is at 18, but if you look at fixed strike vol, it's only about a half a vol point day over day. So, that's not a screaming head for the hills moment. Miss and we put a dent in the AI or semi-chip narrative, then that obviously is going to hurt quite a bit. But, right now it feels like a little more like bending, not yet breaking.
Brent, I like the bending, not breaking. The other thing, too, is that earnings, there's growth, there's high single-digit growth. I think it's hard to blame it on that. The thing that I was really paying attention to is in the crypto market softening up is kind of the edges of froth, in my opinion. So to see that kind of lead to some extent here, I do think that there's a possibility that maybe we just have to wipe some of the froth off the top, and that's kind of where I start with the crypto world. When you look at the levels for the S&P, when would this get interesting to you? I mean, when would we need to have a conversation about, maybe testing some of these dips? Because the Bitcoin dip is pretty real at this point.
Yeah, the Bitcoin dip is pretty real, and the vol in Bitcoin has actually been pretty light until now. So to your point, I think that when you sort of look at risk appetite, there's definitely a dent in that narrative now as Bitcoin is testing 100K. Gold and silver has also come down quite a bit off those highs. In the S&P here, we seem pretty fluid all the way down to the 6,700 level, and there is some indications of what we call positive gamma in that area where we would likely see some support. The other thing is we're entering this area of or time frame of seasonality, and in the past we've had these markets where things look a little ugly at the end of October, November, and then all of a sudden the market just catches this kind of ghost bid, right? And there's so much to that kind of Santa Claus dynamic into the end of the year, right? And not only that, we've also seen some firming of expectations of rate cuts from the Fed in December. So, yes, things are looking a little chippy out there, but the tough part is if you didn't get long puts before this, it's hard to argue. It's hard to see that there's a ton of value now that the S&P's down and vols are up a little bit. Puts aren't a screaming buy at this moment. Calls are starting to get a little bit cheaper. And if you just also look at the S&P term structure, there's a bump around PPI next week, and then there's a really big node or volatility implied event vol around the NVIDIA earnings. So I still think that, right now we can all point to a few sources of potential risk, but those are all just potential risks. If Mondami gets elected tonight, who cares, right? Is the market really going to crash?
I don't
probably
think so,
not, right?
but that's why by the way, another reason Chicago's the future of finance. Well,
yeah, there's just all these things that are there's just all these things that are like, potential risks you can point to, but none of them are actually real at the moment, right? Like
sure.
missiles haven't really start flying. Let's hope they don't in some more material way. Again, if AMD misses and puts up some really ugly number that dents the AI narrative, then fine. But OpenAI keeps locking up these deals, right? They just announced another with Amazon. So, that narrative still leads. And as long as that narrative is intact going through AMD today and I think into NVIDIA next week, then you still have to keep that Santa Claus rally idea intact, almost outside of every other asset, right? Because the AI story is still, leading the country. I mean, that's most of our GDP growth, right? And certainly most of the hope of the stock market, rests with that narrative.
Yeah. The chart generally is pretty calm compared to the morning. We've just kind of been floating a little bit since a little bit of it hit. Brent, what do you see when you look at the options flows? Is there any big skew? Is there anything out of the ordinary when you kind of look at that second derivative stuff that you monitor? Where is it moving? Where is the convexity in the market?
The dominant feature of today's activity is call selling in those mag names that I mentioned before, specific Tesla and NVIDIA. And call selling in NVIDIA, it looks systematic. It's quite large. It's about $1 billion worth of delta in each asset. And so that speaks to some type of systematic unwind. And the idea of call selling is a little less scary than put buying because call selling does not have the same downside convexity, right? As an asset drops, call values go to zero, whereas if you're long puts and a stock drops, obviously that adds to the value of those put options, right? And that adds to the potential of hedging flows there. So, right now it just seems like, again, some contraction of upside expectations. But these rallies off of moves like this have been very violent. If you look at 1010, what happened in that spasm, the VIX hit 30 on like a 2% S&P drawdown, and then within about a week, 1 to 2 weeks, we had moved back through those levels to make fresh all-time highs, right? So again, this idea that people want to monetize volatility as a way to generate alpha, I think is one that will continue to be in play until there is an actual kind of event that rolls everybody over. So if you want to highlight something there, you got to keep an eye like on the credit market, for example. There's been some rumblings of some issues there. And if you have a situation where credit defaults increase or we have more credit issues, then what happens is you get a source of equity put buying that is sort of agnostic to stock prices, right? Because they're hedging credit events.
That's the more speculative side. Yeah. They're really,
and
betting on the downside. The other thing too is that to the same theme of how people are using options, how these ETFs are using options to create guardrails around the market. There's a lot of folks who are very comfortable at this point with as much as double-digit drawdowns. There's buffer funds that are, very simply blocking off the downside. Even if it's, brutish in manner, that's where that kind of guardrails start. Others that are selling options and using basic, sell calling or callers are fine with a little volatility. So I do think that's kind of what's important about the messaging of, always kind of thinking about the context for this show, Brent, is I do think that's why people are employing these strategies. So, until we get to down real double digits, it's kind of like, interesting, but it still is a market that feels like it's supportive and people will be comfortable with it.
It does seem to be that way, in this day of also the short-dated options. There's more ETFs now than single stocks. There's unlimited amounts of leveraged ETFs, put selling, call selling. You can get any asset class for an ETF. So on one hand, you go, that's great, kind of the democratization of finance, the open access to any asset class really in a pretty liquid instrument like an ETF. All those things are great. They have not broken the market yet. It seems like that's the case. Where it starts to get funny is, you look at some of these ETFs and you get leveraged ETF in like gold or silver, and you start to add some of these leveraged ETFs into things like commodities, like, cattle or something like that. And you can start to see where just sort of speculation and leverage in some of these assets that really matter to people, like on a basic level, could potentially become a problem. You think about like ETF-induced convexity in hamburger price, cattle and your hamburger plate, right? Then that can become a problem. So, at the moment, though, everything operates relatively smoothly, to your point. Like, yes, there's a little bit more, I think, intraday volatility now in the market dynamics, overall change, but the stability is pretty solid. Like, outside of the April tariff conundrum, we've seen odd moves like VIX go to 30. S&P only goes down 2% and VIX goes to 30, but ultimately that just mean reverts and it's not like a multi-day systemic issue. So, so far these derivatives and, ETFs and options are not causing, the type of issue that I think a lot of people were worried about.
Yeah, well said. All right, so a little bit of, crypto softening, the presage, some of the equity market softening, but people generally pretty comfortable. Not a lot of speculative, put buying happening at this point. We're going to get ready to have Mr. John Najarian on here, but I actually want to test, Jack, tell me when I go over to our live feed if we can still hear Brent here, because that spot gamma if I can, man. There we go. Okay, nice. We're in. Brent, okay, since we're in spot gamma, real quick, before I let you go, where should I be looking? What's the most interesting thing here today? $67.72 right now. All right, down a 1% move, not the worst. Here, I'll make sure. There we go. Hey, Brent, try me again.
Yeah, hello?
There he is.
Okay,
all
cool.
Right, all right. Okay, tell me again, Brent, real quick.
Yes. So you see there about $4 billion of selling so far. That's what that purple box tells you. And the range is -9 to positive $8 billion. So, it's negative today, but not end of days. But just bring up Tesla, for example, in that box there, the search box right there. Perfect. And I just want to show you the call selling flow in Tesla. So that purple line is the result of call selling in Tesla. And you can see how linear it is. It's almost like a 45-degree angle, right? And that is just the consistent selling of what looks like November call options in Tesla. And we'll be able to see tomorrow whether this was sort of in the money flow, people monetizing in the money calls, or new fresh positions. But this is the type of flow that I think was really weighing on the markets today. And then the last thing I want to show you here, if you could, Oliver, if you should go to the vol dashboard, hit term structure there.
Okay.
And then type in SPX. So just want to look at the S&P term structure real quick.
Okay.
Okay, last button is on the right. There's the 3-line drop down. It's that one there. And click forward implied vol. So forward implied vol is all the way on the left slider there, and this shows you what the implied vol is if you look between expirations. And so essentially, if forward implied vol is higher than current term structure, was the darker teal line there. What that's telling you is that we should expect vol to be a little bit higher into those expirations. And so what matters there is that big spike. If you hover over that, the big forward implied vol spike there,
right there,
that one right there, that's 1120. Why does that matter? NVIDIA earnings are 1119 after the close, right? So that is reflecting the impact of NVIDIA earnings to the market.
Once again, Brent, it just seems like any time the market comes under any degree of pressure, it's the story is wait for NVIDIA.
I mean, it does seem like that. But all the money, OpenAI and NVIDIA deals is all of the capital in the United States. Markets are really global markets, I guess, are just focused on that, and it's a wild narrative, and but you can see there that the S&P 500 cares, right? So it's not just us conjecturing that's what matters. Those vols are pricing in, the volatility of that event.
Got it. Nice. Okay, so NVIDIA once again is the major thing on the horizon. I mean, I think
and that that's a good 2 weeks out, but it's going to matter, right? And I still think that the AI narrative is just intact. Maybe if AMD really messes up tonight, then that's an issue. But otherwise, NVIDIA is the big story. So, so we're excited.
Brent, great stuff. Thank you very much, sir. I want to make sure that I throw up your guys' deal you got going on here. You got some new product coming out. I know you guys are launching. And here's the boom. Scan it, folks. Hit it. I'm going to make sure it's bigger and better next time. SpotGam is great. I love using it. It's very helpful. The coverage is very helpful. I love to see that vol spike right around NVIDIA earnings. Helps us answer a lot of questions about what's most important to the market. Scan the QR code, 50% off SpotGamma. Brent's going to be here tomorrow too. Appreciate it as always, Mr. Kochuba. I'm going to try and do something fancy for my new production skills here, and I'm going to try and switch you over to Dr. J, who is standing by. Look at him. Look at that, baby. All right. There he is. And here, I think I got a lower third for you right there, John. How you doing, man? I want to make sure I hear your audio. Not hearing. Let's see if that's on me. John, you got your audio on over there, right? Yeah, let's try it. This is a true live show. We gotta blend the. Here we go. John, test. Okay, here. Maybe we might have to troubleshoot on Zoom. I got something for that though. Yeah, we might have to go to the Zoom real quick. John will BRB. 1 sec. All right, Mr. J. How you doing, man?
It's Dr. J.
There he is, Dr. J.
I didn't spend PhD. 7 years in evil medical school to be called Mr.
I was going to give that a shout out to you and your brother when I was doing the intro of the guests here. You guys not only trading pioneers, media pioneers, but you guys have got some pretty serious scientific, quantitative background from your pops and your guys' upbringing too. So good to see you, Dr. J.
Great to be with you, Oliver. Thank you.
Appreciate you hanging with us while we're trying out some new tech. We left the conversation with Brent about NVIDIA, the big vol spike around NVIDIA earnings in a couple weeks here. I know you were watching Advanced Micro, which gives us a little bit of a, I don't know, what do we call it? A surrogate preview tonight or what?
Yeah, I think that's fair to call it a surrogate preview.
Because it's not NVIDIA. It always is behind a little bit, but it still gives us a good indication, I think, of all the demand for AI.
Oh, sure. And I suspect that Jensen Huang, the CEO, will have all kinds of positive things to say, and he should, because he's the first $5 trillion company, and he got there faster than obviously, since he's the first, he got there faster than anybody.
Yeah.
But it's just an amazing story, and it's a great American success story as well. I'm really focused on AMD's earnings tonight. We've had a lot of bearish sentiment going in before today's downward move in the market. We had it just yesterday, some strong, unusual put activity in AMD.
People buying puts?
Yeah, people were buying a lot of puts, 10,000 lots at a time. That's a big trade, because anytime somebody's trading 10,000 puts, number one, they've got a lot of money because you have to fully pay for them. And number two, it's a million share equivalent of a short position. And so somebody is thinking that perhaps they'll have great news tonight, and I hope they do, of course. That it still might not be enough. I mean, they have built so much into the expectations on Wall Street and Main Street for what these AI companies, whether it's a data center, whether it's somebody that makes server racks, like Supermicro, somebody that makes cooling systems for data centers, somebody that makes power for data centers. Everything has been moving up pretty strongly. And obviously the chip makers are at the top of that list. They're at the very pinnacle of that pyramid. And I'm worried that perhaps the big buying of these puts indicates that people think there is just not going to be enough good news in the report. I think it's got to be good news tonight. But again, Palantir's earnings were great. They really were. And a lot of us would use dips like today, perhaps, to establish bigger positions in Palantir. But
yeah, it's a pretty big hit, 10% for Palantir. But I mean, the chart just put in new highs. Same story with semis. Last week when I was looking at the market, I was kind of getting back in touch. And one of my main points was that the SMH, the semiconductors, that chart looked like a better technical situation than the S&P, and then they broke out, they made a high, now they're giving some back, but kind of the same point we were discussing with Brent, which is, if you are buying puts, I feel like you're going to have to be pretty quick to take profit if it hits tonight.
Yeah, I don't disagree with that, especially if you're betting that its impact will be in the market, that it'll be not just isolated to AMD. I really do believe that their data center chips are going to be just in huge demand, because there's only so many places you can turn for that, Oliver. And AMD, Intel, and of course NVIDIA are the monsters in that space, and they will continue to be for quite some time. Qualcomm is jumping into that space, but they're not in with both feet yet. It'll take a couple quarters before we really see them perhaps make a dent and take market share away from one or all three of those. But right now, I think it's really going to be an issue of is whatever AMD says, if they beat by 50 cents, if they beat by $1, is that going to be enough to satisfy the biggest bulls on Wall Street? Or will
Probably,
it be, okay,
maybe more
we
than,
priced that in.
Need a little bit more, right? I mean, like the bar's pretty high. Just looking at the chart for AMD, $252, right? How how low were those puts they were buying, John? Like how deep down there are they looking?
They were buying the 240 and the 230 puts. So
Okay.
Reasonable drops out of the
$20.
market to be expressed by, a put that's that far out of the money. And it could just be a huge shareholder. The one thing we don't know, of course, about buying of calls or puts is it their only position? In other words, sometimes shorts buy calls. Why would they? Well, because they're still committed on the short side, but they want to cap how much money they could lose. Similarly, people that are long in a given stock like AMD could decide to set a floor under the market for how much they could risk. This didn't feel like that because it was 10,000 and then an hour later, 10,000 more. So those are pretty big bets that perhaps people are worried, if not straight out betting, that there could be a little turbulence, to borrow a term from Brett, who was on with you earlier.
The thing about the chart, I think, for AMD is basically if you break through, SMH basically 340. For AMD, it's like 240, I think, is, you start trading under there, it starts to get pretty nasty. You would think that's area is going to hold. I'm just looking at it on the chart right now. Right, you got a lot of action between 240, 242 or so. So I feel like these people buying the puts down below there, they're looking for some serious breakage. I think that might scare people. John, do you think any of the Michael Burry stuff is worrying the market at all? I know that, who kind of cares? He was pretty early on this trade, and it seems like he's cried, recession and downside a few times in the last couple of years, and he's missed, not to take anything away from his legendary big short, obviously.
I think the suspicious part here is, well, first of all, Michael Burry, I enjoy your work tremendously. I think you're a really smart guy. But here's what I'm going to throw out to you folks. He didn't have to file this until the end of next week. Why did he file it yesterday? That to me seems suspicious, because if you're Michael and you're short and it's worked against you pretty hard, because he was short at the end of September, Oliver, that's what this 13F is all about. And how he's done on that, not well. He's lost a lot of money, both on time decay and on the direction of the market until the last two sessions. So I think it was wise of him to get filed early, because people that pay attention to smart guys like Michael Burry would see it and say, wow, maybe I should lighten up. And for him to do that at a time while the markets, the government is shut down, is, I think, a smart move. Because if we get to Wednesday or Thursday this week and finally the Democrats break the stalemate and they open the markets, we could be looking at a 1,000-point rally in the Dow. And that isn't going to be good if you're short two of the biggest beta stocks in the market, both Palantir and NVIDIA. So I think he was smart to get that information out there, and he did put his money where his mouth is. So I always respect that from any investor or trader. If you just tell me, well, I think, that the stock's going to go up or down, okay, great. Who cares? But if you put your money on it, I like the commitment. And there's a friend of mine that used to say, for breakfast, the chicken made a contribution, the pig made a commitment. And
I love that. Nice.
I think you're seeing the same thing here with traders when they make a commitment by putting their money on the line. It's not just cocktail conversation. It's not just, oh, I think, Lovey, that maybe we're going to see the markets rally tomorrow or sell off or whatever. I think overall, the people that do what Michael Burry does, and a friend of ours, yours and mine, Brian Sullivan over at CNBC, he was saying, I wonder why he bought puts instead of selling the stock. I could tell you immediately, Brian, the reason he did that was he defined his risk when he went into the trade by buying a put option. It's all he can lose. And he gets a leveraged bet. If he would have been in a short position in the stock, he might have lost on that 5 million share short bet for Palantir. He could have lost 120 to 160 million dollars based on my calculations. But instead, options, and I don't know which strike he's long of those puts, but I do know that the market had gone up since the end of September, and he was looking at some pretty big losses coming into yesterday and today. So I'll just kind of leave it at that.
And he probably needs him to pay off fast.
Yep, because again, time decay works against you. And, you know, the shorter dated options that you trade, the faster that time decay is.
Yeah, very true. So if you're coming up on it, then you really got to hit it. So, Hey, the other thing I wanted to pull up here, John, while I got you, if you got about 120 more seconds for me, is the government shutdown, which has lasted a lot more long than 120. Kalshi right now just pulled it up, says that, you know, this is going to keep going on. By the way, when I talked to your brother about it, I was kind of saying like, you know, come on, this is not going to last, you know, a month plus. I was wrong. Kalshi's now saying 61% chance. Obviously, you know, we go past 41, and their implied forecast is 43 days right now. I mean, this is kind of screwed up, John.
Oh, yeah. Yeah. And, you know, I'm a guy like you, Oliver. We both get on planes all the time. You're going to be coming out here to New York. I'm going to be going back down to Puerto Rico. The airport, they haven't been a mess yet. I've been at, 6 airports in the last probably 8 days. But I do think that we're going to get to a point with the TSA folks not being paid or not being paid a full salary, that things are going to slow down precipitously at the airports. I don't look forward to that. But right now, this is, I think if certain elections like New Jersey and Virginia, if they go in the Republican camp, you're going to see Democrats settle this thing like that. Because right now it's the Democrat shutdown. If they're able
tied
to
the
eke
record
out
35 days.
Yeah. If they're able to eke out victories in those states, I think they could stick with it for longer. But if they lose, then they know that this is forecasting the midterms for them, and that is not good for a Democrat Party that is already underwater with their approval from the American people.
Yeah, very true. Very true. John, great stuff, dude. Always a pleasure. And like the range, the event. We didn't hit sports though, but I'm just catching up to markets. So next time we'll talk what's going on with football. Football, right? That's the big, everybody's betting on NFL right now, right?
That's right. That and Indiana and Ohio State. That's what we care about, Oliver.
All right. We'll see what Scott Bauer cares about for his football bets. John, thank you very much, sir.
Thank you, Oliver. Good luck, everybody.
Thank you, sir. John Ajarian, co-founder of Market Rebellion, alongside his brother Pete, of course. Let's get Scott in here, who is in the room. He may not have turned on yet, but that's okay. We'll get to Scott. Here's a few things that are on my mind while I got you. I'm going to do a little freestyle here, which to look at the risk radar, which I think is worth a glance. Here's where it was last time. This was the risk radar last I left it, which was yellow Bitcoin, yellow bonds, red dollar, and green gold. I think the charts command a shift in this. Now, what I had originally pointed out was Bitcoin's bearish divergence, which was the fact it was making higher highs, but with less and less momentum. So even though the price was trending higher, this long-term bearish divergence held. And my view is that Bitcoin needed to at least test the 110, and since it broke through it, I think we switch BTC over to red. And I think that a few other things shift with that too. I think stocks now are yellow on my risk radar. The reasoning for that is because if Bitcoin's pulling back the way it is, then you kind of think about risk assets in general being at risk. Now, I generally agree with what Brent and John both pointed out, which is that the stock market has such strong resilience for so long. I don't think anybody's really worried about stocks necessarily getting hit. So from that perspective, I'm not too worried about equities. But the red light on Bitcoin, I think, is pretty real. Oh man, I wish that were a live background. Is that live? No, that's a... Man, that looks very good over there, Scott Bauer. That is a very nice hit, sir. I like that background in Colorado. Scott, can you hear me? All right, we'll let him get set up for a second. Back to the risk radar for... Hey, there you go. What's up, Scott?
How are you, Oliver?
What's good, man? I'm running a couple different wheels here spinning.
I hear you.
How are you? We were just talking about a few main items. One is that you've got the market kind of slowing down. Two is that Bitcoin got hit in a real way. What do you make of it? Tell me about generally kind of the vol pop that we're getting, basically.
Definitely risk off across the board. And from what I understand in the crypto space, over the last probably 36 to 48 hours, there's been about $1 billion, that's a billion with a B, $1.2 billion worth of liquidations from long positions that have hit the tape. That is a massive, massive amount of liquidations. And these were all in futures, not the actual Bitcoin, not the actual hard coins, but in future. So there is
ETFs are using futures now too.
Yeah, absolutely. And there's a concern out there that, you know what, the whole narrative with the Fed has shifted. And, maybe we get that cut in December, but we could come to a screeching halt because of that. So, what that goes to tell you is that, Bitcoin hovering in the 110, whether it's 108, 114, whatever it was, a lot of that was elevated up there because of what the market believed was going to happen with rates. And so, that's an area that got hit first, got hit hard, and really is one of those first because of the 24/7 trading and, easy accessibility. Any
Which
news
is, by
comes
the way,
out that
like one of the main value adds of it, it gave us indications over the
sure
weekend.
is.
And that's what I always say too.
It sure is.
It's an indicator. That's really what it's good at. So if you were watching the weakness in crypto, you kind of got a head start on the some of the softness here.
There's no doubt about it. And it was interesting trade today because after selling off early to the 102 level or so, it did bounce back for a little bit, and then mid-afternoon today we saw it just get punished. So reaching 100,000, is that significant? It's only significant because 100,000 is one of those psychological numbers. It's really not a significant technical price point. But the fundamental narrative here is Bitcoin maybe isn't the risk asset that people thought it was, right? It's being treated just like when people want to liquidate something, that's where they're going to. So I think the narrative really behind this, though, is that the market doesn't believe the Fed is on a path to keep lowering rates.
Kalshi says we're going to get at least one more. I think it had something like 60% for rate cut again. But I'll say, I didn't really think they needed to do the last one, Scott. But
I'm in your camp.
Also, why they did it too. I get that if inflation's come down, which it has, and there's no reason to hike, then it's kind of a binary thing where if you don't have to hike, then it probably behooves you to just help the economy by keeping rates as low as possible. But if they need to keep cutting from here, and if that was the logic for this, then I don't see why they wouldn't do it again, basically, unless something revs up on the inflation front. But then it seems like people are more worried about things slowing down.
There's no question about that. I mean, the December one is still priced in. Last market's
losing you a little bit there, Scott.
It's what we're looking at into 2026.
Okay.
Yeah. So that's where the big issue is. And you know what? The labor market is slowing down. We've seen that for a while, and that's just been building and building and building. And now it's really, coming to fruition. And then you throw in the uncertainty of not having the data points, even if people thought the data points were, misguided, irrelevant, not accurate, whatever it was, we still had those data points. We still had the jobs numbers. And not having that is now starting to take its toll. It was novel for a couple weeks not having that, but now we're into weeks 5 and 6 here. And all that does is throw a lot of uncertainty into the marketplace and quite frankly, into the economy at a really, really bad time of year when, the holiday is literally just around the corner. And this time for the consumer, for retailers, and I don't know about you, but people that I speak with are already looking for the ultimate Black Friday deals, are already waiting to buy things because there's too much uncertainty out there, whether it's again from the shutdown, whether it's politically, geopolitically, the Fed.
The shutdown's a little bit weird at this point. I do sympathize with that, come on, 45 days or 42, Kalshi says is expected. That's pretty ridiculous.
It is absolutely ridiculous. And, that goes to the climate that we're in right now. But regardless of what side of the aisle anybody is on, what do we know about the market? What is something certain we know about the market? The market does not like uncertainty.
Yeah.
Right? Bottom line.
What about the earnings, though? AMD, NVIDIA, are these not the most certain things out there right now?
Are they the most certain? They'll probably
AI?
They'll probably do really well, and I think that they'll still give fantastic guidance. Is that going to be enough to kind of turn the screws a little bit on what has been, I would say, a very positive earnings season in terms of reports? But the market reception to it obviously has left a lot to be desired. So is that going to be enough to sway sentiment? I'm not so sure at this point. Now, that being said, 1 day, 2 days does not make trend.
Yeah.
These last, the volatility we've seen over, let's even call it the last week, that could go away in the next few days. That could go away next week.
VIX 20, it's not like, come on. We've been here before. We've had worse. To the point of the earnings, though, but also kind of the economy, Scott, I'm going to try and pull up something that I thought was pretty interesting, which is a tweet that somebody put out. I've actually seen this chart several times. Okay, so I don't know the person who posted this, but it came up on the feed, and it basically shows the timing of this big break between total job openings in blue and the S&P 500 in black. You can see this with me, right, Scott?
I sure can.
Yeah, and right there is the ChatGPT launch. So people are, talking about how this is the end of the world chart. Basically, we're in this giant bubble. I think it's the exact opposite. Like, isn't this just called productivity? This literally what we're doing right now, at least what I'm trying to do, somewhat with varying degrees of success here, is running a show with the help of AI that's helped me build graphics, it's helped me figure out how to do this stuff. That's productivity. So markets love productivity. That's the backbone of the corporate, scheme that we're in here. And by the way, this is basically since the story since COVID too. So this chart doesn't scare me, to be honest. I feel like it almost is just such a powerful statement about what we should expect from NVIDIA, AMD, and others.
I couldn't agree with you more, and I know that we are in the minority. This is innovation. This is how, economics work. This is what we have seen for as long as you and I have been alive, and probably for as long as, the markets have been around, is that there's always going to be new technology. There's always going to be this new innovation. There's always going to be the next greatest thing. And sure, the market is scared right now that AI is going to take away jobs. And maybe we're starting to see some of that with some of the big guys, with some of these layoffs. But I really think that's more of some pressure to say, all right, if we lay off these people now and then realize that 6 months down the road, we have to hire them on back, that's a lot better than holding on for the next 6 to 9 months and then having to lay people off. So I actually think that as AI matures, and as most people say, I don't even know if we're in the first inning yet, second inning, or if we're in pregame warmups, right? We don't know that yet. But as this matures, I think it is actually just going to add productivity, as you said, and I think we're going to see a lot more job creation.
And the earnings growth is behind it too. So I do think, I think it's a different conversation if AMD bombs. At any point, if there are holes in the AI thesis, that's when I start to say, okay, real potential bearish developments. But the macro, the wall of worry, the politics, all that just doesn't really get me that hyped up, Scott. That's kind of the concluding point I would offer. I got red for Bitcoin because of the technical breakdown. I got yellow for stocks. I got green for gold. That chart seems like there's probably dip buyers ready.
Absolutely. And I would agree with you. And the one thing that I would say that I am really concerned about, though, is the consumer. And we know the consumer has held up. For the last 2 years, all we've heard is, the consumer's pulling back. The consumer is shifting where they spend their disposable income. Instead of maybe going to Macy's, Nordstrom, and the like, they're going to TJ Maxx or Ross stores, that sort of thing. So the consumer has held up. But is this time any different? Is with the holiday season right here, is this really the time they're going to pull back or not? I do think that the way they moved over the last several weeks, at least before the last few days, was absolutely a positive for consumers. But now that, the 10-year is back above that magic number of 4, which people look at, and, mortgage rates have tipped back up a little bit after hitting their low point in over a year or so. We'll see how much that does play into swaying consumer sentiment and what they do for the holidays. But I do think that, it is pretty critical, Oliver, and watch maybe some of the retailers this holiday season. I wouldn't be surprised if we literally start seeing in the coming days pre-Black Friday specials, Black Friday price coming
ticket
out
prices
now.
Weren't cheap, man. I'll tell you what, I'm going out to Arizona, and glad the family reimbursing that one. No joke. So it seems like people even in New York this weekend, it seems like the travel, market's still strong, which I would think means that, there's good indication for holiday. So let's watch AMD. Let's come back to it tomorrow, Scott.
Sounds great.
You the man. Thank you very much.
Thank you.
Love that shot, man. Jeez, I got to get out to Colorado. Scott Bauer, Prosper Trading Academy. Thanks a lot, sir. Thanks for joining Chicago Future of Finance. It was a fun little ride there. We're going to iron out the kinks, and I'm liking, though, driving. It's almost like a little bit of a DJ situation going on here. 2 p.m. to 3 p.m. Central Time. By the way, as I mentioned, next week, November 10th, Benzinga FinTech Conference. That's going to be pretty darn good. I'm talking options. I'm talking ETFs, everybody. So I'm very much looking forward to that. That's in New York, so go get the ticket, if you haven't already. I'm looking for my credits. Come on, where are we at? I know we got one more. By the way, we never ran the gamble either. All right, thanks a lot for tuning in.